Imagine two portfolios. One offers a higher expected return with less risk than the other. Choosing the worst portfolio would seem irrational, yet investors do it without realizing it. Modern portfolio theory maps the possible choices, eliminates the dominated ones, and identifies the strongest reward for risk. Then comes the surprise. Investors with completely different risk tolerances may still begin with the same risky portfolio. In today's lecture, we are going to study modern portfolio theory and efficient portfolio choice. This is one of the most important ideas in investments because it changes the way we think about risk. Many beginners look at an investment one asset at a time. They ask, is this stock risky? Or does this bond have a good expected return? Those are useful questions, but they aren't enough. Modern portfolio theory tells us that what really matters is how assets work together inside a portfolio. A portfolio isn't just a list of securities. It is a combination of exposures. Each asset contributes expected return, but each asset also contributes risk. And that contribution depends not only on the asset's own volatility, but also on how it moves with the other assets. That is the powerful idea behind diversification. In this lecture, we will discuss portfolio weights, expected return, portfolio risk, covariance, diversification, the opportunity set, the minimum variance portfolio, the efficient frontier, the risk-free asset, the capital allocation line, the tangency portfolio, investor risk preferences, and finally, the connection between portfolio theory and asset pricing. By the end, you should understand not just how modern portfolio theory works, but why it is such a central framework in finance. Let's start with the basic building block of portfolio choice, portfolio weights. A portfolio weight tells us the fraction of total wealth invested in a particular asset. If an investor holds several assets, each asset receives a weight, and all of the weights together describe the full portfolio. The idea is simple but very important. Portfolio weights tell us where the investor's money is allocated. If short selling isn't allowed, each weight must be 0 or positive. In that case, the investor can choose to hold an asset or not hold it, but cannot take a negative position. If short selling is allowed, a weight may be negative. A negative weight means the investor has sold that asset short. The investor is effectively borrowing the asset, selling it, and hoping to benefit from a future decline in its value. Short selling adds flexibility, but it also adds risk and may be restricted in practice. Now, when we think about the expected return of a portfolio, the concept is straightforward. The portfolio's expected return is the weighted average of the expected returns of the assets inside it. This is why weights matter so much. A higher weight on a high expected return asset pulls the portfolio's expected return upward. A higher weight on a low expected return asset pulls it downward. But expected return is only one side of the story. In portfolio theory, investors don't simply chase expected return. They also care about risk. And this is where the analysis becomes much more interesting, because portfolio risk isn't just a weighted average of individual asset risks. To understand portfolio risk, we must understand how assets move together. Portfolio risk is usually measured by the variance or standard deviation of portfolio returns. Standard deviation tells us how much portfolio returns tend to fluctuate around their expected value. A higher standard deviation means more uncertainty. A lower standard deviation means returns are more stable. But here is the key insight. Portfolio risk depends on covariance. Covariance measures how two assets move together. If two assets tend to rise and fall together, their covariance is positive. If one asset tends to rise when the other falls, their covariance may be negative. If their movements are weakly related, covariance may be small. Correlation is a standardized version of this idea. It tells us the strength and direction of co-movement. This is where diversification comes from. If two assets are perfectly positively correlated, combining them doesn't provide much diversification benefit. They move together too closely. The portfolio may still spread money across assets, but the risk reduction is limited. If assets are less than perfectly positively correlated, the portfolio can achieve risk reduction. The assets don't move in complete lockstep, so weakness in one part of the portfolio may be offset by strength or stability elsewhere. This is why a risky asset isn't automatically bad for a portfolio. An asset with high standalone volatility may still improve the portfolio if it behaves differently from the assets already held. That is a central lesson in investments. We shouldn't ask only, is this asset risky by itself? We should also ask, how does this asset affect the risk of the total portfolio? That question is the heart of diversification. Modern portfolio theory becomes especially useful when we move from two assets to many assets. A multi-asset portfolio may include stocks, bonds, cash instruments, real assets, commodities, currencies, funds, or other securities. The model treats each asset as a source of expected return and risk. To analyze such a portfolio, we need three major inputs. First, we need expected returns. These are estimates of what each asset or asset class is expected to earn. Second, we need variances or standard deviations. These describe the standalone risk of each asset. Third, and very importantly, we need covariances. These describe how the assets move together. As the number of assets increases, covariance becomes more and more important. With many assets, the portfolio is affected by many pairwise relationships. The quality of the portfolio analysis depends heavily on how well these relationships are estimated. In practice, this is challenging. Expected returns are uncertain. Volatilities change over time. Correlations aren't stable forever. During market stress, assets that normally seem diversified may suddenly begin moving together. Portfolio managers also face constraints. They may be unable to short sell. They may face maximum position limits. They may need to maintain liquidity. They may follow a benchmark. They may face taxes, trading costs, or regulatory rules. So modern portfolio theory gives us a clean framework, but real-world portfolio construction requires judgment. The model helps us organize the decision. It doesn't remove uncertainty. This is exactly why it is valuable. It gives investors a disciplined way to think about trade-offs. Now, let's introduce the portfolio opportunity set. The opportunity set is the collection of all risk-return combinations that can be formed from the available assets, given the investor's constraints. Imagine a graph where risk is on the horizontal axis and expected return is on the vertical axis. Every possible portfolio has a place on that graph. Some portfolios have low risk and low expected return. Some have high risk and high expected return. Some may have unattractive combinations. The opportunity set gives us a map of feasible choices. This map is useful because it allows investors to compare portfolios visually and conceptually. We can see which portfolios are available, which ones involve more risk, and which ones appear to provide better compensation for risk. Within this opportunity set, one portfolio has a special role, the minimum variance portfolio. The minimum variance portfolio is the risky portfolio with the lowest possible risk among the available risky assets. On the risk-return graph, it is the leftmost point of the risky asset opportunity set. This portfolio is important because it defines the lowest risk that can be achieved using only risky assets. But we must be careful. The minimum variance portfolio isn't necessarily the best portfolio for every investor. It is the lowest risk risky portfolio. That is all. Some investors may want higher expected return and may be willing to accept more risk. Other investors may prefer to stay closer to the minimum risk choice, so the minimum variance portfolio is a reference point. The next major concept is the efficient frontier. The efficient frontier is the set of portfolios that provide the highest expected return for each level of risk. Equivalently, it is the set of portfolios that provide the lowest risk for each level of expected return. In other words, these are the best trade-off portfolios among risky assets. A portfolio is efficient if no other feasible portfolio dominates it. A portfolio is inefficient if there is another available portfolio that is clearly better. Dominance can happen in several ways. One portfolio may offer the same risk but higher expected return. Another may offer the same expected return but lower risk. Or another may offer both higher expected return and lower risk. If any of these alternatives exists, the original portfolio is inefficient. This is a powerful idea because it tells us that rational mean variance investors shouldn't voluntarily choose inefficient portfolios. Why accept less expected return without reducing risk? Why accept more risk without gaining expected return? The efficient frontier helps investors focus attention on the relevant set of choices. Moving along the efficient frontier usually means accepting more risk in exchange for higher expected return. This is the risk-return trade-off. But portfolio choice isn't simply about maximizing expected return. A very high expected return portfolio may involve more risk than an investor is willing to bear. It is also not simply about minimizing risk. A very low risk portfolio may not offer enough expected return. The investor's job is to choose the right balance. Now, we add a new ingredient, the risk-free asset. A risk-free asset has a known return over the investor's holding period. In the theoretical model, it has no uncertainty and no covariance with risky assets. The risk-free asset changes the portfolio choice problem in a major way. Before introducing it, investors choose only among risky portfolios on the efficient frontier. After introducing it, investors can combine the risk-free asset with any risky portfolio. This combination is called a complete portfolio. Part of the investor's wealth may be placed in the risk-free asset, and part may be placed in a risky portfolio. A conservative investor may hold more of the risk-free asset. A more aggressive investor may hold more of the risky portfolio. If the investor puts some wealth in the risk-free asset, the investor is lending at the risk-free rate. If the investor puts more than total wealth into the risky portfolio, the investor is borrowing and using leverage. This is a theoretical possibility in the model, although in practice, borrowing may be limited, costly, or unavailable at the same rate. When we combine a risk-free asset with a risky portfolio, the result is a straight line in risk-return space. This line is important because it shows all complete portfolios that can be formed from the risk-free asset and that selected risky portfolio. The slope of the line measures the expected excess return earned for each unit of portfolio risk. A steeper line is better. This leads us directly to the capital allocation line. The capital allocation line, or CAL, shows combinations of the risk-free asset and a specific risky portfolio. For any chosen risky portfolio, we can draw a line from the risk-free asset through that portfolio. The line represents all possible complete portfolios created by changing the allocation between the risk-free asset and the risky portfolio. The slope of this line is the reward to volatility ratio, also known as the Sharpe ratio, when the risk-free rate is used as the benchmark. The interpretation is simple and powerful. The slope tells us how much expected excess return the investor receives per unit of total risk. A flatter capital allocation line is less attractive. It provides less expected compensation for risk. A steeper capital allocation line is more attractive. It provides more expected compensation for risk. So, once the risk-free asset is available, investors don't only compare risky portfolios by their location on the efficient frontier. They compare them by the slope of the line they create with the risk-free asset. The best risky portfolio is the portfolio that creates the steepest feasible capital allocation line. This portfolio is called the optimal risky portfolio, or the tangency portfolio. It is called the tangency portfolio because its capital allocation line touches the risky asset efficient frontier at exactly the best trade-off point. Once the tangency portfolio is identified, the portfolio choice problem becomes much simpler. Under the standard assumptions, investors combine the risk-free asset with the tangency portfolio rather than choosing separately among all risky assets. Now we need to ask an important question. If all investors agree about expected returns, risks, and covariances, will they all hold the same complete portfolio? The answer is no. They may agree on the best risky portfolio, but they can still choose different amounts of exposure to it. This is where investor risk preferences enter the analysis. Some investors are more risk-averse. They dislike volatility more strongly and prefer a larger allocation to the risk-free asset. Other investors are less risk-averse. They are more willing to tolerate volatility in exchange for expected excess return, so they allocate more to the tangency portfolio. In the mean variance framework, risk aversion determines how much total risk an investor chooses to bear. This gives us one of the most elegant ideas in modern portfolio theory, the separation of decisions. The first decision is risky portfolio selection. This means identifying the risky portfolio with the best risk-return trade-off. Under the standard theory, that is the tangency portfolio. The second decision is capital allocation. This means deciding how much wealth to place in the tangency portfolio and how much in the risk-free asset. The tangency portfolio is about market opportunities. The allocation between the tangency portfolio and the risk-free asset is about investor preferences. This is why different investors may use the same risky portfolio but end up with different complete portfolios. A conservative investor scales down exposure. An aggressive investor scales it up. Same risky portfolio, different total risk. Before we finish, let's discuss practical interpretation, limitations, and the link to asset pricing. Modern portfolio theory is powerful because it forces disciplined thinking. It reminds us that diversification matters, covariance matters, and investment decisions should be made at the portfolio level rather than the individual asset level. But the model depends on inputs that must be estimated. Expected returns are especially difficult to estimate. Small changes in expected return assumptions can sometimes lead to large changes in optimized portfolio weights. Risk estimates can also change. Correlations can shift over time, especially during market stress. Assets that look diversified in normal conditions may become more closely related when markets are under pressure. Investors also face real-world frictions, taxes, trading costs, liquidity needs, leverage limits, short-selling restrictions, concentration limits, and regulatory constraints. These limitations don't make modern portfolio theory useless. They tell us how to use it wisely. It is a framework for disciplined portfolio construction, not a mechanical guarantee of perfect performance. Finally, modern portfolio theory connects naturally to asset pricing. If investors can diversify, they shouldn't require compensation for risks that can be diversified away. Instead, expected return should be connected to systematic risk, the risk that remains even in diversified portfolios. That idea leads to models such as the capital asset pricing model and multi-factor asset pricing models. The common message is clear. In finance, risk isn't only about how volatile an asset is by itself. It is about how that asset contributes to the risk of a portfolio. Thank you for watching. I hope this lecture helped you understand modern portfolio theory and efficient portfolio choice.